There's a moment happening in the markets right now that most people are completely misreading. They see a headline that says, "Rich investors are selling gold," and they think, okay, gold must be bad. Maybe I should stay away. Maybe this thing has run its course. And that's exactly the mistake that transfers wealth from the people who don't understand the game to the people who do. So let me tell you a story, because what's happening right now isn't complicated once you understand the mechanics, but nobody's explaining it properly. And that gap in understanding, that gap is costing regular people an enormous opportunity. Picture this: a hedge fund manager is sitting at his desk in Manhattan. His portfolio has two big positions. One is a basket of technology stocks, the kind of stocks that went parabolic during the AI boom, Nasdaq heavy, growth heavy. The other position is gold. He bought gold 2 years ago, and that position is absolutely crushing it. We're talking about gold going from roughly $2,000 an ounce in early 2024, all the way up to an all-time high of over $5,600 an ounce in January 2026. That's nearly a 180% gain. He's sitting on a fortune in profit. Now the stock market starts wobbling, tech stocks start dropping, the Nasdaq pulls back 10%, 12%, maybe more, and suddenly his brokerage calls, not his assistant, the brokerage itself automatically through a system that has no emotions whatsoever. It says 4 words that every leveraged investor dreads: you have a margin call. A margin call means he borrowed money to build those positions, and now that his stocks are down, the collateral he used to secure that loan isn't worth enough anymore. He needs to deposit more cash. Right now, not tomorrow, right now. So what does he sell? Does he sell his tech stocks that are already down? No, that locks in losses. He sells the thing that made him the most money. He sells gold. Institutional investors, facing margin calls on plummeting equity positions, began liquidating their most profitable asset, gold, to cover losses elsewhere. That's not a sign that gold is broken. That's a sign that leveraged players are in pain and they're raising cash the fastest way possible. You cannot get a margin call on a gold coin. This is the secret the financial media never properly explains. When you see gold selling off during a stock market correction, your brain says even the safe haven is falling, everything is dangerous. But the reality is the opposite. The fundamentals haven't changed. The people who truly understand gold aren't panicking, they're watching, and the smartest ones, they're quietly buying. Now let's talk about what's actually happening in the world right now, because the backdrop for gold is unlike anything we've seen in decades. The US federal debt has blown past $37 trillion. That number is so large it stops feeling real, so let me give you a frame of reference. If you stacked $37 trillion in dollar bills, the stack would reach the moon not once, but roughly 150 times. Every year, the US government spends more than it takes in, and every year that debt grows. US debt was estimated at $37.43 trillion, and some 125% of gross domestic product in September 2025, and it's growing at an alarming rate. Here's why that matters for gold. When debt balloons at that pace, there's enormous pressure on the Federal Reserve to keep interest rates low, or even cut them so the government can afford to service the debt. Lower real interest rates are historically rocket fuel for gold. Gold doesn't pay a dividend, it doesn't pay interest. When rates are high, you're giving up real yield to hold it. But when real rates are low or negative, gold shines brighter than anything. The US Federal Reserve reduced its federal funds rate in 2025, and consensus estimates show investors anticipate around 75 more basis points in further rate cuts in 2026. These rate cuts should reduce the US real interest rate profile, which is normally constructive for gold, since gold shows a negative correlation with real interest rate developments. But wait, there's more, and this part is the piece that most ordinary investors don't know about. The central banks of the world, not retail investors, not hedge funds, but the actual governments of countries, have been buying gold at a historic pace. We're talking about a sustained buying spree that started in 2022 and hasn't stopped. In 2022, central banks bought a record 1,080 tons of gold. In 2023, they bought 1,051 tons. In 2024, another 1,089 tons. Think about that. The treasuries of nations, China, India, Poland, Turkey, Kazakhstan, are consistently offloading US dollars and replacing them with gold. Around 755 tons of central bank gold purchases are expected in 2026, still elevated compared to pre-2022 averages, which were closer to 400 to 500 tons per year. These are not emotional buyers. These are not retail investors panic buying after watching a YouTube video. These are sovereign wealth managers making deliberate, multi-decade decisions. They're saying quietly that they trust gold more than paper money, and they've been right, because gold has been the best performing major asset class over the past 2 years, nearly doubling the returns of the S&P 500 over the trailing 12 months. Now let's come back to this correction, because I want you to understand exactly what it looks like from the inside, so that next time you see it, you don't run, you recognize it. After touching a historic high of $5,626 on January 29, 2026, gold embarked on a turbulent descent, retreating toward $4,492 by March 20, a 20% correction. Here's what triggered it. On February 2, 2026, the CME Group announced an unprecedented 36% hike in maintenance margins for silver futures and a 33% hike for gold. This forced over-leveraged speculators, many of whom had entered the market during the FOMO-driven rally of late 2025, to liquidate their positions instantly to meet margin calls. This created a classic selling begets selling cascade, as stop-loss orders were triggered across the board, sucking liquidity out of the market in a matter of minutes. So let's be crystal clear about what that means. These weren't long-term gold investors who studied the fundamentals and changed their minds. These were leveraged traders who got caught in a squeeze. They didn't want to sell gold. They had to. There's a massive difference between those two things. The physical market, where actual metal changes hands, told a completely different story than the futures screen. Physical gold premiums stayed elevated. Demand from stackers, jewelers, and institutional buyers held steady. That right there is the tell. When paper gold is being dumped but physical gold demand doesn't fall, that's a temporary dislocation, not a structural change. That's the market taking out its leveraged tourists before the next leg higher. Now think about this through the lens of history, because gold has done this before, and the people who understood it got extraordinarily wealthy. Looking at the current gold environment through the lens of the two previous major bull markets provides helpful context. The 1976-1980 cycle produced roughly 500% cumulative returns, and the 2001-2011 cycle produced roughly 600% cumulative returns. The current cycle, which began in 2022, has generated approximately 200% so far. Importantly, both prior bull markets experienced 5 corrections of 10% or more along the way. 5 corrections, every single one of them felt terrifying in the moment. Every single one of them felt like the end of the run. Every single one of them was an opportunity, and then, quietly, relentlessly, gold powered higher. The recent pullback represents the second such correction in the current cycle and falls well within historical norms. So when someone tells you the gold bull market is over because it dropped 20%, ask them which correction in 1977 or 2008 or 2012 marked the end of the bull market. The answer is none of them, not a single one. The bull market ended when the underlying macro conditions changed, when debt stopped growing, when real yields stopped being suppressed, when central banks stopped buying. None of those things have happened, not even close. Let's talk about the wall of money that's still waiting to get into gold, because the scale of this is staggering. Nearly $14 trillion is invested in gold globally, including central bank holdings, physical bars and coins, ETFs, and over-the-counter positions. This compares with more than $100 trillion in global government debt and roughly $150 trillion in equity market capitalization. Now here's the math that should make your jaw drop. A modest 1% reallocation from government bonds and equities into gold would represent about $2.5 trillion, an 18% increase in outstanding gold investments in what is already a tight physical gold market. Such a shift could both support prices and create a tailwind toward $5,000 per ounce. 1%, that's all it takes. And we're in a world where more and more institutional managers are being asked by their clients, their pension fund clients, their sovereign wealth fund clients, their insurance company clients, to add real assets as a hedge against currency debasement. The demand is not slowing down, it is building. And the smart money sees this. UBS targets an average gold price of $5,000 per ounce, Standard Chartered forecasts $4,800, and JP Morgan's baseline for 2026 is $4,753. Goldman Sachs raised its year-end 2026 target to $5,400 per ounce as recently as late January. One analyst put it bluntly, "I've said in the past that 2025 was the perfect storm for gold. Now it's a Category 5 hurricane in 2026. But here's the thing I really want you to internalize, because this is the mental model shift that separates people who understand wealth from people who simply earn money. Gold is not an investment in the traditional sense. You're not buying it because a company is growing its earnings. You're not buying it because of a dividend. You're buying gold as a form of financial insurance. You're buying it as a vote of no confidence in government's ability to manage their debts responsibly. And right now, the evidence that governments cannot manage their debts responsibly is overwhelming, bipartisan, and global. Think about what's happened to purchasing power over the last century. $1 in 1913, when the Federal Reserve was created, is worth about 4 cents today. 4 cents. The dollar has lost 96% of its purchasing power in a little over 100 years, and the pace of that erosion is not slowing, it's accelerating. Gold, over that same period, has preserved its purchasing power, and then some. Your grandparents probably didn't own gold. Their generation trusted the system. They put money in the bank, earned interest, and retired on fixed pensions. And for a while that worked. But the world they lived in, the world of Bretton Woods, of genuine savings rates, of manageable national debt, that world ended in 1971 when Nixon took the dollar off the gold standard. Since that day, every currency on earth has been a faith-based system backed by nothing but government promises. And gold has been rising steadily against every single one of those currencies ever since. Now let me address the people who are skeptical, because I want to be honest with you. Gold is not for everyone in every circumstance. If you're carrying high-interest debt, you pay that off first. If you have no emergency fund, you build that first. Gold is not a get-rich-quick trade. It won't triple your money in 3 months. If that's what you're looking for, you're in the wrong game. But if you're someone who's working hard, saving money, building wealth for the long term, and you're watching inflation quietly eat into everything you've saved, then ignoring gold is not a neutral decision. It is a decision to let your purchasing power shrink. So what do you actually do? Let me be specific, because vague advice helps nobody. First, understand what vehicle makes sense for you. You have a few options. You can buy physical gold. Coins like the American Gold Eagle or the Canadian Maple Leaf are among the most liquid and widely recognized. Bars are an option for larger amounts. The premiums on coins can run 3% to 5% above spot price, but you own the actual metal with no counterparty risk. Nobody can issue a margin call on a coin in your safe. Second, if you want exposure in a brokerage account, gold ETFs like GLD, the SPDR Gold Shares, or IAU from iShares give you price exposure with high liquidity and low expense ratios. IAU charges 0.25% annually. These are not the same as physical gold because they involve some counterparty risk, but for most investors, they're a practical and efficient entry point. Third, and this is the more aggressive play for people who have done their homework, gold mining stocks offer leveraged exposure to the gold price. When gold goes up 10%, a well-run gold miner can go up 20% or 30% because its profit margin expands dramatically. But this leverage cuts both ways. Mining stocks are volatile, exposed to operational risk, and require actual research. They're not set it and forget it. For beginners, stick to physical or ETFs first. Fourth, think in terms of allocation, not all-in bets. Most financial professionals who take a serious approach to this suggest somewhere between 5% and 15% of a long-term portfolio in gold, not your entire savings, not half your net worth. A meaningful allocation that provides real protection without creating concentration risk. Think of it as the fire extinguisher in your financial house. You don't want your whole house to be a fire extinguisher. But you absolutely want one in there. And here's the timing piece that matters right now. We just had a 20% correction in gold from all-time highs. One major analyst described this current phase as the 4th or 5th inning of the bull market, pointing out that the fundamentals, unprecedented deficit spending, growing debt, and persistent uncertainty, remain firmly in place. The leveraged speculators have been flushed out. The froth is gone. What's left is the actual durable demand from central banks, institutional investors, and long-term holders who understand what's happening. There's a concept in markets called climbing the wall of worry. It means that bull markets don't go straight up. They advance, they correct, they shake out the weak hands, they advance again. Every time they correct, the financial media writes the obituary. And every time, the people who understood the fundamentals bought more and were eventually proven right. We're at that point right now. The obituary is being written. The weak hands have been shaken out, and the people who understand the cycle are buying. The current market dynamic echoes the liquidity crunches of 2008 and 2020, where gold was initially sold off to provide cash for other obligations before eventually rebounding. In 2008, gold dropped about 30% as the financial crisis exploded. Then, from that bottom, It went on to reach $1,900 by 2011, a 170% rally from the crisis low. The people who bought during the panic didn't just preserve their wealth, they multiplied it. And the underlying conditions today are more favorable for gold than they were in 2008. The debt is larger. The geopolitical fragmentation is deeper. The trust in institutions is lower. The de-dollarization trend is real, visible, and accelerating. Within 2025 alone, gold overtook the euro as the world's second most widely held reserve asset and was recognized as a Tier 1 asset in the international banking system. That last point deserves to land properly. Tier 1. That means banks can now hold gold as the highest quality capital, equivalent to cash and government bonds. That is a fundamental structural change in how the global financial system classifies gold, not a trend, not a narrative, a formal regulatory reclassification that doesn't reverse. So the next time you see a headline that says, "Rich investors are selling gold," stop, take a breath, ask yourself why, dig one layer deeper. Because more often than not, when you see the rich selling something at a loss, it's not because the thing is bad, it's because something else went wrong and they needed cash. And the thing they're selling at a temporary discount, that might be exactly what you should be adding. The wealth transfer doesn't happen in headlines. It happens in the gap between what people react to and what they understand. Margin calls are not a referendum on gold's value. They are forced liquidation by people who played a leveraged game and got caught. That's their problem. It doesn't have to be your problem. It can, in fact, be your opportunity. You don't need to be a hedge fund manager to understand this. You don't need a Bloomberg terminal or a finance degree. You just need to understand the cycle. You need to understand that the people forcing gold down right now don't want to sell, they have to. And you need to understand that when the forced selling stops, what's left is a market priced for the people who held on, and for the people who were smart enough to step in when everyone else was scared. That is the window. The window doesn't stay open forever. But right now, in late March 2026, while the headlines are grim and the sentiment is confused, the window is open. Don't sleepwalk through it.